All right, welcome to this explainer. Today, we're diving into exactly why mastering the timeline of the Indian financial markets is absolutely the ultimate edge for any trader out there. Most people obsess over finding that one perfect stock, but today, we're going to look at the markets through a completely different lens, the lens of time. So let's just kick things off with a massive question, one that honestly gets totally ignored by most beginners who are hyper-focused on what to buy. The question is when you trade just as important as what you trade? And the short answer is a resounding yes. Seriously, a perfectly read setup that you execute at the wrong time of day or looking at the wrong time frame chart can completely wreck an otherwise brilliant trade. But hey, before we get into the nitty-gritty, we've got to bust a famous myth right out of the gate. You've probably heard people swear up and down that Monday is the best day to buy and Friday is the best day to sell. Look, if everyone bought on Monday and sold on Friday, basic supply and demand economics would literally break down within a week. The reality is, there's no single magic day of the week that guarantees you a profit. It's all about timing the intraday momentum and really understanding the broader calendar. To make sense of all this, here is our agenda for this explainer. 1. The daily trading anatomy. 2. Choosing the right time frame. 3. The commodity market marathon. And 4. Holidays and special sessions. Okay, kicking off with Section 1, the daily trading anatomy, the modes of the equity market. Think of the trading day as a living, breathing entity with 3 completely different moods. First, we start with the volatility window in the morning, where prices are just swinging wildly. Then we hit the midday lull around 10:30 a.m. This is when the big institutional traders kind of take a breather and the market goes relatively flat. And finally, we have the closing rush kicking in around 2:30 p.m., where volume absolutely surges again as everyone aggressively closes out their daily positions. Let's zoom right into that chaotic morning window. From 9 to 9:15 a.m., the market actually runs a pre-market session to discover the opening price and match early orders. Then, the bell rings. The first 15 minutes of the open, from 9:15 to 9:30, are incredibly erratic. It's often driven by what we call dumb money, just reacting emotionally to overnight global news. This is exactly why beginners should sit on their hands until 9:30 a.m. Between 9:30 and 10:30 is really the sweet spot. The early noise clears out, and the true direction for the day finally starts to emerge. Now, skipping ahead to the very end of the day, there is a hard, non-negotiable rule you've got to respect. If you're holding an intraday trade past 3:10 or 3:15 p.m., you are risking an unpredictable auto square-off by your broker. They will forcefully close your position to prevent delivery, and trust me, they'll hit you with unfavorable execution prices and extra penalty charges. Nobody likes donating free money to their broker, right? Always manage your own exits before that 3:15 mark. Moving right along to Section 2. Choosing the right time frame so we can actually survive these daily phases. Now, this matrix right here, it's basically the holy grail of multi-time frame analysis. It brilliantly breaks down how you should use a 60-minute chart just to get the big picture context, right? Then you drop down to a 15-minute chart to find those key supply and demand levels. And finally, you zoom all the way into a 5-minute chart to actually pull the trigger. You never want to trade blind based on just one single time frame. And guys, this time frame choice becomes incredibly critical when we start talking about options. When it comes to options, your time frame totally depends on your strategy. Option buyers, you are in a desperate, ticking clock race against time, so you need fast 5 to 15-minute charts to get in and out quickly. Option sellers, on the other hand, well, they can afford to kick back on a 30 or 60-minute chart and just let those larger trends play out nice and slow. So why the huge difference? It all comes down to theta. Theta decay is essentially the amount an option's price decreases as it inches closer to its expiration date. So the brutal reality for buyers is that every single minute you spend waiting around on a slow, sluggish chart is a minute where theta decay is quietly eating away at your premium. And yeah, that happens even if the stock price is completely flat. To fight back against that decay, here's a rock-solid, structured approach. Step 1, confirm the broader trend on your 15-minute chart. Step 2, wait, and I mean wait patiently for the price to pull back to a support level. Step 3, switch over to your 5-minute chart and execute the entry only when you see a confirming candle form. This step-by-step method totally stops you from guessing and ensures your exact entry timing lines up perfectly with the big picture market momentum. All right, shifting gears to Section 3, the commodity market marathon, looking at the MCX and NCDX. Before this marathon even starts, traders get a super tight 14-minute window. Yeah, literally just 14 minutes, from exactly 8:45 a.m. to 8:59 a.m. Participants can modify or cancel pending orders so they can react to overnight global news before the incredibly long commodity trading session officially kicks off. And when I say marathon, I absolutely mean it. The commodity market runs in two massive continuous blocks, a morning session from 9 a.m. all the way to 5 p.m., flowing seamlessly into an evening session that runs deep into the night until 11:30 p.m. or even 11:55 p.m., depending on U.S. daylight saving time. Unlike equities, non-agri commodities trade late, which actually makes it an amazingly flexible space for people who want to trade after they get home from their 9-to-5 jobs. So you're probably wondering, why on earth do we keep these markets open so late? Well, it's not arbitrary. These extended hours are strictly necessary because commodities like gold and crude oil are global assets. Indian commodity markets absolutely have to stay aligned with the massive Asian, European, and American markets. If they didn't, traders wouldn't be able to react to global supply shocks or major foreign economic data releases that drop while most of India is asleep. Which brings us to our final segment, Section 4, Holidays and Special Sessions on the 2026 calendar. Zooming out to the macro view for the 2026 calendar year, the NSE and BSE are going to observe exactly 15 full weekday closures. These specific days are set aside to honor national holidays, state elections, and major cultural festivals. But the real anomalies, the ones you absolutely have to map out ahead of time, are the long weekends. In 2026, holidays like Good Friday, Maharashtra Day, Muharram, and Christmas all fall on a Friday. Listen, if you are an options buyer, holding a position over a 3-day weekend means you are eating 3 full days of pure theta decay. It'll completely crush your premiums before the opening bell even rings on Monday. Now, beyond the scheduled closures, there is this fascinating cultural anomaly in the Indian markets. It's totally driven by a deeply rooted belief that trading during one specifically designated auspicious hour will bring long-term luck and financial prosperity. Which, of course, leads us to Muhurat trading. For 2026, this special 1-hour session is scheduled for Diwali Lakshmi Pujan on Sunday, November 8th. And get this, even though it falls on a Sunday when markets are strictly and traditionally closed, the exchanges make this amazing exception and will actually open up for this highly anticipated symbolic 1-hour session. Wow, okay, we've covered a ton of ground in this explainer today, from the crazy volatile first 15 minutes of the morning to the late-night commodity sessions, all the way to the yearly holiday calendar. As we wrap this up, I want you to look back at your past losses and ask yourself this one final crucial question before you ever place your next trade. Are you blaming your trading strategy when the real culprit might actually just be your time frame? Master the clock, and I promise you, the charts will start making a whole lot more sense.